Welcome back to Radio Rothbard. I'm Ryan McMaken, executive editor at the Mises Institute. And on this episode, we're going to talk a little bit about commercial real estate and specifically multifamily. Also, we talk a lot about single-family housing, and I think ever since the, especially for those of us who remember it, we still talk a lot about single-family delinquencies and single-family markets because that was such a big driver in the last financial crisis. And I think maybe there's also just we think about it because that just became our framework at the time, back, a long time ago, more than 15 years ago now. But as people have been noticing, I think, in the last 18 months or so, talking about some of the indicators of how shaky is the economy looking, they've noticed that, especially Doug French, for example, who writes here from Mises.org a lot, notice there's a lot of news in commercial real estate. And that's not just multifamily, right? It could be office, it could be retail, and of course, major cities. Ever since people stopped going to work thanks to COVID in downtown centers, office is just a big problem for a lot of owners. So I want to talk about those sorts of things. And to do that, I brought on Artis Shepherd. And he writes some of my favorite columns here on real estate and on the boom-bust cycle here at Mises.org. And we've never had him on before, but just to give you some information about him, he's the founder and managing partner of a private equity firm based in the Dallas-Fort Worth area and previously worked for a sovereign wealth fund in the Middle East, overseeing their hospitality investments in Europe, Africa, and Asia. He has a BS in computer and electrical engineering from Purdue and an MBA from the University of Chicago. He publishes content at mtsobserver.substack.com if you want to check that out. But of course, you can always see his columns at Mises.org, at least the ones he submits to us. So, Artis, thank you for joining me today.
Thanks for having me.
And I've really appreciated some of your recent columns just on apartments and more broadly just on commercial real estate. So, I mean, just to really get into it, my question is, as I've just mentioned a few minutes ago, right, the last couple of years, people have been pointing out delinquencies and foreclosures, less in single family and more in commercial. So would you say that in these sectors, right, let's just look a little bit at retail, office, multifamily. Are they all encountering some similar problems? Do they all have the same root? Just kind of give us a roundup of what the deal is with commercial real estate and where some of the biggest problems are right now.
Sure, it's a little bit of both. Remember, the bubble that we've just observed was called the everything bubble. So to some extent, all asset classes were affected by this broad inflationary force. And so retail, office, even hotel, multifamily, single family, all of those asset classes saw massive increases in valuations. So to that extent, they've all been impacted by that same source. Now, as we've seen, these bubbles haven't exactly burst, but they've kind of deflated. And as we've seen that deflation, values at the top end have come down a bit, but you still have that residual inflationary impact on the cost structure here. So taxes have gone up, have not come back down. Insurance has gone up, has not come back down. Payroll has gone up, has not come back down. All of those things factor into the fundamentals of the P&Ls in all of these properties. And so you have that kind of basic foundation that the bubble impacted these properties by. But there are some idiosyncrasies. Office is an obvious one. So you had the COVID panic of 2020 when the government essentially shut down the office work environment. And I mean, it can hardly be understated how big of an impact that had. Essentially, the entire office investment market could be considered obsolete at this point. Now, there's some movement back in that direction, but underwriting office investments was difficult to begin with. Now that this bomb was thrown into the office market, it's even more difficult and unappealing for investors. So you have that aspect on office in particular. Retail was similar. You had a bunch of people staying at home, not shopping. They were being told not to congregate, not to do these things. aside from certain, allowable places like grocery stores or whatever. So you can imagine the impact that had on retail. A bifurcation sort of developed where if this was big box, big credit retail, where you had strong corporate, maybe publicly traded retailers, they could get over this hump. But if you had mom and pops operating a strip center, they obviously went bankrupt. And so the larger credits were strengthened. This is a common theme with government intervention, obviously. So you have that, the residual of that right now, which is a lot of those mom and pop retailers went out of business. And so that the investment market is now even more dominated by those corporate credits. Multifamily, which is where I have spent most of my time over the last 5 or 6 years, was, in my opinion, the most interesting. So when you had trillions printed by the Fed in 2020, there has to be a mechanism by which that money enters the market. And the mechanism by which it entered the multifamily market was that wholesale lenders like JP Morgan and people like that began aggressively lending, in terms of wholesale lending, to bridge loan lenders. So bridge loan lenders, I'll just describe this product real quick, Ryan, and stop me if I'm getting too specific or too complicated. But bridge lending has been around for a while in commercial real estate and multifamily, and it essentially entails short-term loans that are bridging a gap from acquisition until stabilization. So usually it's used to do some sort of improvement. And this sort of product in multifamily in 2020 took on a whole new character, very high leverage. So we're talking about financing 80 to 85% of the acquisition costs, very low underwriting standards. I can talk about underwriting standards forever, but essentially we remember the subprime lending issue back in 06, 07, 08, where anyone could get these loans. That sort of thing happened in multifamily. So you had these, and they were also floating rate. Let's keep that in mind. These were floating rate loans at a time when benchmark interest rates were zero effectively. So someone could come in, borrow 80 to 85%, fill in the rest with some investor equity, 3 years term with a couple of extension options, and really do a lot of business this way. Again, the underwriting standards were fairly lax. So what you saw in multifamily was massive speculation in those markets, particularly in the Sun Belt. I live here in Texas, and I would routinely see Texas apartment investments being offered at 3 caps. 3 cap meaning a cap rate of 3%. So a cap rate is the income a property produces divided by the purchase price. So, treasuries typically are quite a bit higher than 3%. They weren't at that time. But you can imagine risky apartment investments going for valuations that were on par with where treasuries typically are, or even less than treasuries. So the multifamily market right now is kind of dealing with the residual of all of that activity. It's not looking very good, but those bridge loans took over the multifamily market in 2021 and for part of 2022. A lot of the originators I spoke to, the guys that originate loans for multifamily, said 90 or 95% of the transaction volume during that time was from these bridge loans. So, I've written a lot about bridge loans, and I can talk specifically about that in as much detail as you want, but that's the general character of multifamily right now, is they are dealing with what happened in those boom years.
Well, to expand a little bit on why the bridge loans are needed, and why let me just say it this way, or just ask it this way. Are you saying then that a few years ago, 5, 6, even more maybe, in this period of ultra low interest rates, right, from 2010 to really after, they started to go up in 2019 and then crashed again, right, in 2020. And you mentioned these are floating rate loans, right? So this is something we need to make sure the audience knows, right? Is that these are not like home loans, which are these 30-year fixed, right? These can be very sensitive to interest rate changes. So was there a sense, and I don't know the answer, was there a sense of that investments in retail and in multifamily was close to being riskless, and then as interest rates went up, suddenly it became a big problem, or how would you phrase the change that occurred since 2019?
I would put it this way. Someone said when money is loose, fools become entrepreneurs. Money was very loose at that time. Like I said, if trillions are printed by the Fed, that money has to find its way into the economy in some way. And so these bridge loans became very aggressive to outcompete the kind of existing loans at that time. So Fannie and Freddie compete in the multifamily market as well. And they have a huge presence in multifamily. And these bridge loans outcompeted Fannie and Freddie during that period because Fannie and Freddie were subject to certain strictures that came out of their failure in '08 and '09. They failed so badly that certain strict underwriting requirements were put in place, and Fannie and Freddie stuck to those. The bridge loans had a little more flexibility. So they outcompeted Fannie and Freddie and took over the multifamily market. And so in that case, you have a group of multifamily investors who are looking at this in one of two ways. You have folks who are kind of conservative who look at this and say, this is unsustainable. These are floating rate loans at a time when benchmark rates are zero. They have nowhere to go but up. And cap rates, so valuations, cap rates, are also as low as they've ever been. There's tremendous risk here in terms of buying these properties. That's one perspective. You have another perspective, which is, man, this money's easy to get. And if I can do a lot of these loans and a lot of these acquisitions, I can make a lot of money for myself as a sponsor in fees. Forget about the investors and the moms and pops and the people whose money you're putting at risk. But as a sponsor, this was pretty tempting. And so you can see the dynamic that develops here. The people who were able to take advantage of this environment were the people who were willing to pay the most. And in effect, to do this kind of, this high risk venture for their equity partners. But for them, it was kind of a quick hit. Let's do as many of these as we can, get as much out of it as we can, and then, whatever happens, happens. That is a story in itself, which I've written about, like what's happening with those sorts of sponsors. But so to answer your question specifically, Ryan, it didn't become riskless. It just became subject to kind of the bifurcation of investor types. So the least scrupulous investors took over, the more conservative investors backed out, and the market was kind of left in that sort of situation.
All right. Well, looking at, right, this, when we look at people who are unscrupulous, right, or people, certain conservative people are staying away, certain people who want to buy up multiple properties are flooding in. It makes me also think of Airbnb and the sorts of things that we saw, right, during the old housing bubble, right? Remember that? Yeah. One of the favorite jokes of that period was from the movie The Big Short, right, where the Steve Carell character goes and interviews the stripper who turns out owns like 10 condos. Yeah. And so the idea was just flood in, buy as much as you can, and sure, it'll be fine. And now we're starting to hear that sort of thing about single family, right? Where, okay, there's tons of inventory now in the market. Realtors are posting videos saying all of my clients are delusional. They refuse to list at a price that could actually sell. And so there's all of these problems in that market. Now, as you know, of course, though, problems in single family don't necessarily mean problems for multifamily. It could be that if the single family market's all messed up, that people just go into rentals or they get cheaper stuff like condos and things like that. I don't know what the current situation is, right? It's never quite clear how single family and multifamily are going to interact just based on what's going on. So how would you characterize it this time? How is the single family market with the surge in inventory, with you're starting to see a little bit of a climb in foreclosures, but nothing that I would describe as major. You're seeing foreclosures in other places. Is single family helping or hurting multifamily right now, or is it just it's unclear? There's just not that big a difference.
It's hard to say. I mean, single family is so local and broad and such a huge market, but I'll try to describe the dynamic that I see. Obviously, single family was subject to all those forces that I mentioned earlier, those inflationary forces. So and we've had a very tight supply single-family market for the last couple of years. That is starting to loosen up now. So does that increased supply help or hurt multifamily? It completely depends. I mean, if a bunch of new supply in single-family comes on the market and you have a bunch of renters who are prospective homeowners, that would hurt the multifamily market in the sense that those renters would now look to the single-family market as, a substitute for rental housing. However, that only works if prices are affordable in the single-family market. I mean, this is not an apples-to-apples thing. There are non-quantitative reasons that renters want to become owners, but just sticking to the numerical aspect, homes have to be affordable for renters to exit their rental situation and go into housing. That is not the case. Housing has become, again, a bifurcated sort of market where the typical buyer these days is older and wealthier than they've ever been. I think, again, we're talking broad numbers here, I think the average existing home price is in the mid 400s. That's a substantial price. It's not easy for a renter paying whatever, $1,500, $2,000 a month to go into a $450,000 home. And by the same token, the average home buyer is becoming older and older. So it completely depends on the nature of that new supply and whether that new supply is affordable to the renters. Now, on the other hand, renters are also facing upward pricing pressure while they rent. One of the big metrics that we use to examine whether a market is affordable to the average renter is something called wallet share. Is basically the amount of rent or occupancy cost divided by the disposable income of a renter. And that metric has increased substantially over the last several years. So renters, these are typically the middle class or whatever the case may be, are stuck between a rock and a hard place where inflation in renting is still there, but there's no appropriate substitute on the single-family housing side in the meantime.
And I mean, it's just so hard to predict, right, where single family's going. With all these realtors saying, yeah, they're not pricing realistically. But it seems like that's just taking forever to unwind, right? There just seems to be no interest in pricing homes to move quickly. I suppose maybe a large part of that is just that unemployment is still relatively low, so you just don't have a lot of people who just straight up can't make their mortgage payments.
Yeah, unemployment is relatively low. A lot of those mortgages are vintage years where interest rates were so low that the burden on them is not that high. There is also a attitude that things are going to change soon. If we can just hold on, rates will come down. And this is obviously encouraged by the regulatory authorities and the amount of jawboning they do. So there are a number of factors that keep this bid-ask spread in place. In Texas, I'll just give you my personal view here in Texas. The home prices here have shot up dramatically. I live about 45 minutes north of Fort Worth. Home prices have shot up dramatically. Homes on the market right now are taking a little bit longer to sell. I mean, some of them used to sell in 24 hours. They're taking a little bit longer to sell. There are some price reductions, but they're not nearly the level that you'd call capitulation. Nothing like that is happening here. There may be different degrees of that happening elsewhere in the country. So, it's extremely hard to predict what's going to happen in single family, but the dynamic at this point doesn't look like any sort of capitulation from sellers.
Well, let's shift a little bit to bonds. One of the things I like about your articles is you talk about bonds. That's something that I wish people talked about more, just because the bond markets they're just far more interesting to me than the stock market in general. And I think there's far bigger geopolitical consequences of bond markets as well. But for those who follow this, right, we all know that in 2008, 2009, the Fed started buying up mortgage-backed securities. And so that's just been kind of this thing floating around in the market, is these trillions of dollars held by the Fed and the Fed's refusal. And, of course, then the Fed started buying up more of them, in 2000 as a way to further prop up the economy. And we got that great talk and some great research done by Alex Pollock, our senior fellow, on basically how the the Fed turned into a giant savings and loan, buying up all these huge amounts of single-family MBSs and such. How do these changes, though, in the current market affect commercial mortgage-backed securities? What can we look to, or what should we look to, really, to get a sense of what's going on with that area of the industry?
So securitized commercial real estate comprises a couple different categories. One of them is CMBS. So CMBS are generally, this is not absolute, but generally characterized by fixed rate loans over 5 to 10 year terms. So that's CMBS. The bridge loans that I talked about, these are called CRE CLO. These are short-term floating rates, so they comprise kind of a different category of securitized commercial real estate loans. And then there are agency loans in multifamily. This is Freddie and Fannie. These are also securitized loans. So you have at least these three distinct significant buckets in securitized commercial real estate. Now, what's going to happen to securitized commercial real estate loans in the next couple of years? I don't know, impossible to tell, but what I can do is describe the nature of securitized commercial real estate loans today and maybe speculate on how that plays out. So we talked about the bridge loans a couple of years ago, and this is a perfect illustration to have this discussion because the same dynamics exist in CMBS, fixed rate longer term loans, but the bridge loans really illustrate the point. So I have looked at specific bonds, bridge loan bonds. I have access to that sort of data. And if you look at these bridge loan bonds, you can see property level metrics. So I'll just back up a step, Ryan, and say when a multifamily loan is proffered, that loan, if it's a bridge loan, is ultimately pooled with a bunch of other similar bridge loans and then securitized. That security is bought up by bond investors. And that's, of course, tranched. You have the A piece and the B piece and the junior piece and all that stuff. So that's the way this thing is structured. So I've been able to look within those bonds and look at the property level data, the underlying collateral. And what you find is really quite interesting. You find that, in summary, some of these bonds have no ability at the property level to fund their debt service. And I mean absolutely no ability. There's something in the industry called the debt service coverage ratio. So if I have a property that I own and the debt service, the interest payments or whatever on the loan are $100, and my property generates $100 exactly in income, my debt service coverage ratio is 1.0. That's not a good place to be. You want to be higher than that. You want to have some buffer. The bonds that I've looked at have an average debt service coverage ratio of around 0.6. So 0.6. And you can imagine why that is. These loans were originated back in 2020 when benchmark rates were zero. Benchmark rates are not zero anymore, and these are floating rates. So debt service has increased substantially since that time. And the underlying property level fundamentals have not improved either. Costs have gone up, mismanagement has occurred, and this sort of thing. So if you see a bunch of bonds in the securitized CRE space operating with half of the cash that they need to service their debt, you would assume that there's some sort of slaughter going on in the bond market, but that is not the case. Why is that not the case? And it's because of this extend and pretend mentality from the banks. I'll give you just a quick example and then broadly discuss why this is happening. One thing that bond services are doing in this case is they're offering borrowers mezzanine loans. So you, the borrower, cannot pay your loan. Therefore, what I'm going to do is give you another loan that will allow you to pay the loan in the short term. So what does that do? Well, it defers delinquency. It defers for the time being any sort of legally enforceable distress, but it exacerbates the underlying problem of insolvency on these bonds and on these collateral. So this is the attitude from the bondholders at this point: is we don't want to enforce delinquency at this point. We want to give these guys as much as they can to kick the can down the road. And that's obviously good for us as the bond servicers, and bond servicers also hold pieces of the bonds. So they're doing as much as they can in the meantime to kick the can down the road, avoid marking down these bonds, avoid marking down the value of the underlying portfolios, and all of that stuff. So that's the big question in the bond market, is how is that going to play out? Is there going to be some amelioration of the situation by the regulatory authorities, or is this going to be allowed to, devolve or evolve in its own way? I think we all know the answer to that, but that's the big question.
Well, of course, we've been talking a lot about the markets, but the markets are by no means free. And so the question is, what role has monetary policy played in all of this, right? That obviously in the last 6 years or so, the Fed has just become so active, so central to everything. And I mean, if you had to point to just one or two things that the Fed has been doing that has really affected multifamily, what would we look to? What would you point out?
Well, I described the mechanism by which I think those bridge loans and that sort of lending entered the market. That was obviously originated by the Fed. Simply put, when the Fed prints trillions of dollars, it can't just sit there to accomplish the goal the Fed wants. It has to enter the economy somehow. So that's one thing. You also can't understate the impact of ZIRP on the average investor's mentality. It used to be the case that I could work hard, save my money, put it in a CD, and over time, I would kind of see my quality of life grow. When interest rates are zero, that option is completely erased. So the average investor, and I'm talking about the retail investor, not the institutional investor, the average investor has to go out on the risk spectrum and do these sorts of things. They have to buy shares in multifamily funds or whatever the case may be. They are more susceptible. I'm not trying to defend kind of naive behavior from mom and pop investors, but they are more susceptible to the sort of marketing and solicitation that we've seen from some of the unscrupulous actors. So you could talk about monetary policy and low interest rates, but I think it's really, there is an attitude effect here on the average investor that is understated. That's a big deal. I think that attitude still exists. You see a ton of retail money in the stock market today. You see the same attitude from other aspects of the capital markets. So, I think those are the two big things. Obviously, the hard money entering the market, which the Fed has printed and injected into the market, is one thing. But the attitude impact on the average investor is another thing. And there's also, in the meantime, this kind of jawboning from the Fed, and not just the Fed, but also the administration, the political administration, that kind of indicates or encourages the attitude of speculation. Things are going to get better. We're going to start doing things for you. We're going to start stimulating this and that and stuff like that. So I think that defers the opportunity to deflate the economy the way it needs to be deflated, and it kind of keeps people looking towards this speculative sort of situation.
Specifically in real estate, what does that look like? So Brendan Brown, one of our writers, he talks a lot about this same issue of how you have to get into, if you're just a regular person who just wants to collect some yield on your investments, you got to get riskier and riskier if you want to get anything out of it. And now there are tons of options available to billionaires, right? Hedge funds, all sorts of creative stuff. And then, of course, they can also afford to lose a lot of that money without ending up living under a bridge, right? But normal people, as they get riskier, that's like real world risk to them in a lot of cases.
Yeah.
But mostly we just talk about some of these more on paper-ish investment products. Like in real estate, what does a search for yield look like in terms of, I want to invest in multifamily or commercial real estate, so on, and I need to now pursue riskier stuff? What specifically are we talking about? Where do they end up going and investing in?
A lot of these investments are sourced through third parties. So again, this goes back to the distinction between conservative investors and kind of the unscrupulous investors. And I'll kind of discuss broadly and then talk about a specific class of real estate. So if I'm a real estate investor, either I have a specific relationship or set of relationships that I can access to fund my property acquisitions. I have family, I have investor friends or relationships or whatever that I know that I've developed a relationship with over years, and there's a certain relationship there. On the other hand, there are third-party aggregating firms, biz dev companies, for example, that go out and, as their business model, go out and solicit this kind of investment from the average investor. I don't know how they do things typically because I've never used them, but you can imagine they put a shiny marketing package together. They have some kind of consumer database that they work with, and they say these people are good targets. Let's send something to them and see how they react. A lot of that happened during the boom phase. And again, those end users were susceptible to that kind of marketing. It also comes in through wealth management companies. A lot of private wealth management companies will pitch these sorts of deals to their wealth management clients. So that's what that looks like. And this concept of aggregating equity to execute an investment is called syndication. Syndication, again, is not new. It's something that has existed in the commercial real estate investment world for decades. But the type of syndication we saw in 2020, 21, 22, combined with the bridge loans that I saw, really sparked quite a speculative environment. And the syndicators themselves were those people that I talked about, the very unscrupulous, in a lot of cases quite young, clearly inexperienced, people that wanted to take advantage of the situation and did take advantage of the situation. So that's what it looks like. That's how it ended up. And I think that sort of thing has died down quite a bit, but by no means has been, it's still there.
Well, as a final question, just looking forward, because you've talked a little bit about this article, and I enjoyed kind of your reference to some special interest groups of property owners and investors who, in a certain slimy way, are already lobbying for bailouts and special treatment, right? As things get rougher. So moving forward, I mean, what would you say are going to be the solutions to the situation that are going to be put forward, right? We all know what the solutions was back in 2009, 2010. It was QE, it was bailouts, it was governments buying up shares in your bank or your auto company, that sort of thing. What are we going to be hearing in the field of commercial real estate, the solutions to the problems that were created, of course, by the Fed and the boom bust cycle to begin with, but of course they're going to swoop in and offer some solutions. So what do you think those are going to look like?
The solutions are going to look a lot like the problems themselves. So these people are real professionals. And by professionals, I don't mean professional investors. I mean, they are very capable professional rent seekers. They are very good at this sort of thing. And if you just look at, for example, the Real Estate Roundtable, which I mentioned in my article, these people are the titans in the real estate industry. And they're titans in the real estate industry because they have this skill, the political skill, not the investment skill. And so what are they going to do? Well, they're probably going to do the same thing they've always done. They've been at this table 4 times in the last 15 years. And some of the tools they use, to use the obnoxious term that the Fed often states, some of the tools they'll use is these sort of, I forget what they call them, but they will facilitate loan workouts, basically. So what that could mean is that a lot of these loans are subject to a regulatory framework, and they will ask for that regulatory framework to be softened. So let's take banks. I mean, banks are one example, but if banks or loan holders write down the value of their loans, that has implications for the rest of their business. That has implications for their ability to lend. It has implications for their compliance and this sort of thing. So they don't want to write down loans, but they have to within a regulatory framework, unless they ask for special provisions, which they will. So they will ask for softening on that so that they don't have to write down their loan amounts. They will, I am sure, ask for short-term loan facilities to be proffered by the Fed or by whatever agency. They will ask for softer treatment of extend and pretend practices. So if I'm a lender and if I am supposed to be taking action if my borrower is delinquent, subject to the regulatory framework, I will ask the regulatory authorities for leniency there. And what I will do is I will say, well, taking action against the delinquency now is actually worse for the long-term value of the loan. If I just hold on and I'm a little bit softer, I am actually serving the interest of the security holder. This is the kind of argument they use. So this is completely at odds with the idea of the market deciding what things are worth. And again, it's an extend and pretend tactic where if I can wait this out, and if I can get some assistance from the regulatory authorities, I can dig myself out of that hole. And again, them digging themselves out of that hole often means just digging a new one that will come back to haunt them later. So it's the same cycle repeating itself.
Well, Artis Shepherd, thank you for joining me today here on Radio Rothbard. It was, as I said in email, I don't think we've ever really covered commercial real estate in any detail, certainly not in recent years. So it was good to get some real detailed information on this. And and of course I agree, right? It's going to be the same sort of rent-seeking behavior that's going to end up how this gets played out in terms of the news and in terms of the bailouts that we're going to see are going to be called for. So it'll just be interesting to see what rationales are offered and how exactly that works. And then, of course, it's just going to blow up new bubbles. It's just going to create new problems for 8, 9, 10 years down the road, and I just don't see any political appetite for changing the way of doing that sort of business. So
agreed. Yeah.
We'll see. Well, thank you again. Thank you, everyone out there, for listening to this episode of Radio Rothbard. We will be back next week with more, so we'll see you next time.